Hi, it's Larry McDonald with the Bear Traps Report. Ben Bry's in the house. Craig Shapiro's here. Crazy day. I mean, really historic in a lot of ways. We're basically at the one of the highest capitulation levels in markets in a long time. We run a Bloomberg chat with hedge funds, mutual funds, and pension funds in more than 20 countries since 2010. Ben Bry's been on the team for a long time. Great leadership. It's like a live ideas dinner. Join us on Bloomberg. Join us in the Discord room. Craig's running that conversation with some of the best investors globally, and we want to just democratize information. We want to give people a lens of what's the buy side really talking about today. And I'll bring in Ben right now. Ben, um, you what we try to do in the chat is pick up on narratives, and you presented a narrative to us way back in December around the Trump team needing to get rates down. We made the point in the book around interest on the debt, and they got to get rates down. There's too much. There's a refinancing. There's a terming out of the debt which means we need to issue much more longer dated debt. So that thesis.
Oh, did we lose Larry there? Craig,
Yeah,
you still
like,
there?
yeah, I'm still here. Looks
All
like we
right.
lost
Well,
Larry's connection, maybe.
yeah. Basically, I think I can just take it from him,
Yeah, he'll come back in.
and so Craig, as Craig knows, because I talk to Craig a lot, is the thesis was very not consensus, and it's funny because I was telling people this, Craig, all you had to do was listen to the guy, right, and what they were saying, like what Musk was saying, what Basant was saying, what was Trump was saying. Like they did what they said they were going to do, and like I think a lot of people um, were, I guess, obviously, like look at what's going on right now. Like I mean, people were surprised. They just denied. They doubted Trump, right?
Yeah. Yeah. Look, I mean, I think, Trump 1.0, would have led you to believe that his commentary about what Trump 2.0 might look like may have been BS, right? I mean, he didn't really deliver on a lot of those themes about cutting the deficit. He obviously delivered on tax cuts, but, he loved the stock market. He always but, he got elected on a different mandate this time. And it was a much more exhaustive mandate, similarly having the House and the Senate. And so, this time he really wanted to talk about Main Street over Wall Street. And that was going to be tariffs. And that was going to be driving down energy prices, driving down the deficit, driving down inflation, which is going to take down bond yields. And that's going to have this pro-cyclical effect of, lowering borrowing costs for the consumer and then lowering interest expense for the government. And so there was a plan here. And I think they knew that it was going to take some pain, right? And that asset markets were going to get hit. And the earlier that they could do it in the administration and in the term was going to be beneficial because they'd be able to blame Biden for, try to gas the economy into the election and run it hot and for all the excess spending. And then they could blame Powell if things kind of got out of hand because they'd say, oh, he's, like we saw today, he can't putt straight. He's always late.
Today,
and so,
exactly.
And so, there's an excuse. Whereas if Trump tried to slow play this and engineer.
There's no value to that, right?
Yeah.
There's really no value to that.
That's right. So there was an incentive to do it quickly. But now we're learning, and it's not surprising, that we're the transition period from what we've had for the last 30 years of deficit spending to, something different, and from a free trade world to a multipolar mercantilist world, the transition period is rocky, and so we're going through it right now.
Yeah, and it's funny because like it, as a guy who's a cynic and who's always kind of like taking the other side, both on the long side and the short side, I'm fairly like accustomed to this, and like this was a weird one because it was like I was just saying what was happening and what the policymakers were telling you they were going to do, and no one just believed it. Like it was very strange relative to historically being like, oh, something complex. Sorry, I got to charge my laptop. I got to put my laptop card. And so here we are, right? Like now everybody knows, right? Like what I was talking about, Craig and Larry, last fall, even long Trump. Honestly, like you can go on Wall Street Beats. I was pitching that to anyone who wanted to listen. I was long Fannie Mae from $2.50 and along Geo, which I don't want. I'm not long anymore because I don't really want to like cheer for like people going to correctional facilities. But like, the point was that was just a pure play on Trump being mispriced. And now this is like everybody knows that it's what's going on now. So like as I told the guys this is the end of the season 1 of the Orange Lotus, and since we all live in a reality TV world, basically that was a dramatic finale. And now what we're probably doing here, and what's important to everybody, myself included, with what I'm trying to do with my funds and what these guys are doing and what you're doing, is what's next, essentially, right?
Yeah.
Larry, you're back.
Hey guys, yeah, sorry. It's at the end of the day, what's the most important looking forward? What's the most important part of this chart, Ben? Looking forward.
I don't know. I have a QR code in front of my face. Can anyone see me? I feel like that check our website is like blocking me out. I mean, I know you're a good advertiser, but like, yeah, there we go. So I sent this to Larry. I sent this to Larry last year, and I put it on Twitter. You can probably dig through my Twitter, and it was like, hey, if you think about the post-COVID world, 2021, I couldn't have been more short SOFRs, Eurodollars actually at the time, but like in bonds. And we got that, and then from 2022 to like,
but let's try to look forward.
No, I'm just trying to get perspective on this. That this was we were at a historic deficit, fiscally, and so everybody, and that fiscal deficits, public deficits are private surpluses. That all filters through to the S&P, whether it's people getting money and buying stocks or it's profits, it's S&P earnings, whatever. So now this is reversing, and right now it feels like, oh, we should take some off, and which I've done personally. So I'm not saying, but if you look at that, like when we had these these points throughout history, this is going through the whole post Bretton Woods period, things continued. Like long bonds, short stocks, like kept going, and I think like look at where we were in that 2000, and that worked quite well, and I think that the 2000 analog is the right analog, because stocks is a percentage of the total world's equities, concentration at the top of the market. The dollar was strong, and now we're getting into Larry's thesis from his book, which you can clearly see there, is that weaker dollar, which has been going on, and money's leaving the U.S., and then people are going to have lower growth. Like the whole thing's going to unwind, just like in 00. And what worked in 00? Housing. That's what these guys want. My biggest long is Rocket Mortgage, okay, and bonds, right? And what's working today? Rocket Mortgage is up, bonds are up. And like they're going to try and deregulate. They probably will bring the SLR exemption back, and they're going to try and
let's because it's a broad audience. So that gets into what we talked about in the book, Financial Repression. If you're forcing the banks to own more treasuries through the SLR, isn't that the Fed's purview? So he needs the Fed support on that, right?
Well, yes, from a regulatory standpoint, right? Like, and so what do we think about, like, unfortunately, like as basically the first millennial. I think I'm the oldest millennial. Actually, I was born in the beginning of 1982, so I'm like the beginning millennials. And we had the best first 20 years of our lives, and then like been a real difficult adult life, because all we've had is this perpetual crises starting in 2000 and then 08 and this. But the one thing you learned about that is rules change during crises. And that's how and so if you think about what's going on right now, like, yeah, it looks really bad out there today and yesterday and whatever. But this is how you go like, oh, you know what we got to do to fix this? We got to deregulate the banks, which we all know. And Larry's been talking about, and Craig's been talking about, and, people understand this, but like, you still got to do it. And so I think that like the other side of this is deregulating financial system, bringing Wall Street. my hat says make volatility great again, but I think it's about make Wall Street great again. Like Wall Street deserved to be in the penalty box after '08, and no one knows that better than Larry as a former Lehman trader. But like, it's 17 years ago. We haven't had private credit creation for a long time, a long time. And like, I think that's what we're coming on to is we need to like take the game away from the government and bring it back to private hands, essentially.
Well, let me push back on the bond side because Dalio's been out there, and I think what he's looking at, Ray Dalio, I think what he's looking at is because there's no new net issuance from January to August, and because we're under the debt ceiling. So we're at the debt ceiling. There's no net new issuance, right? And that means there's an incredible catch up in September, October, November. They're going to have to really catch up. I want to ask Craig, that's if they take the TGA back up to 800. There is a theory out there that percent will keep the TGA low, the Treasury General account. But how are we not going to have a huge bond sell-off later in the year when all this issuance comes into the market at the same time?
Yeah,
Craig,
look, I mean, I think this is part of the thesis about why they got to bring rates down and why Bissett has talked about bringing the 10-year down, and that the 10-year is the most important asset and price in the world, and certainly for the government. And so they're going to do whatever it takes really to make sure that yields are lower. And in their mind, in order to get yields lower, they needed to put a stop on the deficit spending, and they needed to put a stop on inflation. Now, the Fed could have done that. The Fed could have broke the back of inflation, but for a variety of reasons, never did. And so Bissett and Trump have had to come in here and basically break the back of inflation by engineering a slowdown, exacerbated by tariffs for sure, but also heavy talk about DOGE and spending cuts and hitting the federal government employees. It's going to engineer a growth slowdown so that when we go through this refi cycle later in the year, it'll be at lower rates. Now, Yellen never turned the debt out, and Bissett was highly critical of her doing that and issuing bills over bonds for a long period of time, despite the fact that term premiums were negative and the yield curve was inverted. But at his first meeting with the TBAC in the end of January, he basically said, I'm not doing it. I'm not going to do anything about it either. Right? I'm going to keep issuing bills at the expense of bonds, and so I expect that over time, if they can continue to put a slowdown on the deficit spending, we could grow our way back into a more balanced bills versus bonds portfolio over the course of the next few years. And I think that's what they are attempting to do. But that assumes that we don't have a massive, economic contraction in the meantime that really hits tax receipts. But that's why they're trying to get the rates down now. That because of this refi wave that's going to happen after the debt ceiling is resolved and we start to issue again.
Yeah, and Ben, this chart is from yesterday, so today's going to change it, but it's been a great chart. We talk about it in the book too. It's been, if all you ever did the last 30 years is sit in the boat and wait for the percentage of New York Stock Exchange stocks that are above the 200-day moving average. If that percentage gets down below, say, 30, anywhere from, say, 7 to 25%, if that's all you ever did, you crushed the market. You absolutely crushed the market.
100%. And I have another one of these things. I like to look at FX vol. So like if you look at like a sterling yen like risk reversal, 25 delta risk reversal, it's exactly like this. It's the same time. It's like you can see when the max stress is of like, hey, I got to get out of my position, or I'm selling, or there's margin calls, or whatever it is, and like max capitulation. And like we could go down Monday and it could be keeping uglier, but like we're getting closer and closer. Like this has been pretty aggressive, right, Larry? You've been in the game longer than me. Like, what are the comparable periods to the last 6 weeks that we've saw? Like, in your multi-decade career, what do you think like are the comparable periods?
It feels like COVID. It feels like Volmageddon in 2000 and
the Volmageddon was
18.
short though, right?
Yeah.
I mean,
yeah. This has been a good month
I mean, you were
it's
in the
about
game in
4.
'87, right? Weren't you?
We're down
weren't you like-
16. We're down 16% in like 45 days.
I was gonna bring up 87 just because it's always topical and always seen as that crash scenario, and obviously we're going through a similar type crash pattern right now, and the question is, where is the Trump put struck and where is the Fed put struck, right? And so today, I mean, earlier this week, we learned that the Trump put is way lower on S&P than we're trading at right now. And today, Powell reiterated that the Fed is in no hurry to ease liquidity because the potential for persistent inflation to exist longer because of tariffs is there. And the labor market, as we saw this morning with the payroll print, isn't rolling over yet. So there's, the hard data is not reflecting the slowdown in the soft data. So if we don't have a Fed put here and we don't have a Trump put here, the market is getting angry and getting antsy. And we are down. I think there's a chance that we're going to start to search for that put strike level. And
Yes.
it may happen this
Yes.
afternoon and it may happen Monday because that's how this market has been conditioned, right? Every time we get to these critical points, we either get saved by one of these puts, the Treasury, the administration, or the Fed, or we don't, we gap down very quickly, and then ultimately we get saved. So I think we're at one of those critical points right here where we need to get saved. And it's possible that Trump will tweet over the weekend. I had a great call with Xi. We're thinking about thinking about not tariffing each other, right? Just something silly like that. I mean, he just said, I think while we were on here, he extended the TikTok deadline for 75 days. So there, see, that's him caving, right? In the market's mind. If we get
And he could extend the other deadlines too, right?
Absolutely.
The April 9th.
Yeah. I mean,
so that's what I think the market's looking for that this weekend. If we don't get it over the weekend, we come in Sunday night into Monday, markets are down again, and then that's the last vol spike. That's the get me the F out. That's the throw in the towel, and then
that's
you're
the
going to have
70
that
vol, 65 vol, right? Like that's when we get to 65. Like that's when you get to like absolute max capitulation type of thing. Like we're at a 40 vol now, and that's I mean 40 vol is a lot, right, guys? Like this is not this is Adult Swim. Let's use that term. This is Adult Swim here. And like we're in the credit contraction right now. And this chart that Larry just put up is my chart. And
what is that? What's that chart?
So it's a little busy, but I'll just explain it, right? So you have a 2-5-10 butterfly, you have the 2-10 term spread, you have the Mag 7 divided by the equal weighted S&P, so SPW, and you have Bitcoin about gold. You see how they're all the same thing roughly, right? And what I'm trying to show here is these are all variations of credit expansion and credit contraction. So we had a credit expansion in 2020, 2021 post-COVID, and then contraction in 22 into like early, into 23, and then we had a credit expansion. Whether you want to say it was, we funded in bills, or they, Fed or Jake Powell took, the knee, or whatever. Like point is, it's very clear what's happening, right? Like you're seeing it. Mag 7 divided S&P is going down. The bonds are ripping. Like even gold's going down today. And like, so this is just a way of thinking about the markets at a macro level that maybe, again, I mean, I'm not sure everybody has access to like what a 2-5-10 butterfly is. And I don't want to go into that, but it's basically a way of thinking about the term spread. And when we have higher rates and you have a positive term spread, that's good. Like the one thing I would say to people is, and there's a guy named Richard Wagner, who's a PhD from Germany, who is the author of the book Prince of the Yen, and he was in Japan, and he basically has shown that high rates is good, low rates is bad, and we've been conditioned as a society in an over financialized economy that low rates is better and high rates is bad. But the reality is, what's going on right now? Like, does low rates feel good to anybody who's a bull right now? You know what I mean?
What are you trying to say here? What are you trying to say here with this chart? That blue line is
this is a clear. This is a like less busy, more easy.
But the blue line's Mag 7.
The blue line is Mag 7, or it's Mag 7 divided by S&P. I don't know exactly. I have both of them, but it's basically like Meg 7 Nasdaq are when things are expanding with credit, they do well. Like people go into riskier stuff, and then when credit comes in, like the riskier stuff now gets sold relative to. And again, I think you guys know. But my favorite long that I bought this, I like the Rocket, but that's new. But like my favorite long I bought in 2025 is the Budweiser. All right, so but I never bought the Budweiser before, and it's ABI InBev, so it's a foreign company. But everybody gave me a hard time about that in January when I bought it, like $47, $48. And that thing's kicking ass. You know what's kicking ass right now? Stable businesses with stable cash flows, whether it's bonds or it's Budweiser or it's the constituents of the XLP, Monster Beverage, whatever. It doesn't matter. Like if you're not getting disrupted and you're not traded at insane valuations, because tobacco companies and beverage companies, who the hell wanted Staples the last 2 years, Larry? Was there, I mean, like who you talked to way more people than me. I mean, who wanted Staples in the last 2 years? Now all of a sudden everybody hated bonds, hated Staples. Now they're all love bonds and Staples. It's just funny how the market works.
And same thing happened in 2000. Staples outperformed.
Is that right? Is that right? Like that?
Yes, Staples outperformed from 2000 to 2002. Staples outperformed the market by I think 40%. But Craig here, Craig, you're running the live chat. A lot of clients I see are talking about the August low, and we're right there, right? I think you're muted.
Sorry about that. Yeah, I think people are looking at this August low, and looks like we may have bounced off it the first time this morning, or kind of got pretty close there. But I think it's not surprising that we are at this August low level, today into a Friday after we learned about tariffs and after we've learned from the Fed that they're not going to be accommodating. And so we're at this critical juncture here where if we break next week, people may throw in the towel in a much more aggressive way and say something is different now. The shape of the market is different. The economy is clearly slowing. Tariffs are very disruptive. We're in a retaliatory stage. China is retaliating. Europe's probably going to retaliate. And so we're going to ratchet up this trade war, this economic war. It's going to lead to a bigger growth slowdown. And so we're going to go from an inflationary bust period where all these prices go high to a deflationary bust period very quickly because no one can afford anything. And so the growth slowdown will overtake. And I think we're going to learn a lot about that, over the course of the next, that trading over the course of the next 72 hours, and whether or not, really at this point, Trump can give something to the market that it feels like he's going to, that the worst was seen last week for sure. And that he's willing to negotiate, and that countries that come, that I think that's what the market wants to hear at this point, because aside, without that, I'm concerned that we're just going to keep with the uncertainty while the Fed can't provide liquidity. And then we may see a trap door here where that August low gets breached and we start to, probe for much lower levels in order to find that point where the Fed says, you know what? Okay, fine. We could cut in May. So that's what I'm, I hate to be so short term. That's not how we always are, but.
And Ben, you think the first cut is going to be, so I like your theory. You think the first cut is just going to be 75 because they're going to play tough guy, and then you get 75 bips. Is that your point, Ben?
But yeah, I mean, basically my view is like this. I think, all of us went through the GFC. And again, I was too young. So you guys remember the .com. I mean, I was around, but I wasn't in the game at all. So, but this is a credit, as I showed with that other chart, it's a credit cycle rollover. So when you have $325 trillion in U.S. or in debt, and in like 2/3 of it roughly are U.S. dollar denominated, and that's not even including the offshore dollars. Once this happens, it doesn't matter. Like everyone's like, oh, inflation, oh, the jobs reports. Dude, this is $100 trillion global economy with $350 trillion in leverage. Okay, those are claims on dollars. Equities are on top of that.
You're talking about 350 trillion leverage is just bonds.
350 trillion is just bonds, vanilla bonds. And then you have the equities on top of it, and then you also have the derivatives, which is another 2 quadrillion. I don't even like saying the word quadrillion. It's like sound like I'm in a clown show or something. In like basically that's all claims on dollars. And my central thesis is, at the end of the day, Larry's right. Energy is what matters, right? And I know energy is getting its ass kicked today, but like dollars are claimed on energy. It's a potential energy. I go to work and I'm giving dollars in exchange so that I can go on a cruise, or I can take my kid to school, or you know, or to a show or whatever. Like all these claims on dollars. That's what we're going through. That's how this is. That's how a leverage system works. And I think there's just a misunderstanding that, like, because all the economic theory came before we put on this massive leverage in the post-Bretton Woods era. And so a lot of our understanding is from the old world when it was like a more balanced. That's how it would be. But like in a massively leveraged world, all that matters is, as Craig was saying, refinancing and the credit expansion or credit contraction. And that chart I was showing is just an easy way to see which way are we going. And when you're credit expanding, you own the app loving, or you own the Meg 7, or you own whatever. It doesn't matter. And on the other side, you know, you own bonds and you own cash, gold, you know, whatever, but you're not needing that residual risk. And I think that's kind of my point of this whole thing, is that like when we think back at January of 08, we just passed the first cut. So stock market was at all-time high, fall of 07. Then we got the 50 basis point cut. And I remember very distinctly, I was sitting in Shanghai with a bunch of guys from, you know, it was SAC at the time, now, which is now 0.72, and a few other people on a conference there. And Bernanke did a 75 basis point cut because we'd had 3 days in a row. And it was only like, it was like 3%, 4%. I can't remember exactly. It was kind of like this. It was like ugly. And I kind of just thought this whole thing was like basically an analog of January of 08. And it ends when the Fed does, you know, the stabilizer. And I think 75. I don't think that, like, Craig, you know, you love talking about the Fed.
Let me just quickly just reference this chart, because one of the things that Craig looks at is we have a model that tracks all the commodities relative to bonds. And the same thing was, and we said this a couple of weeks ago, the rate of change in, say, oil and copper relative to the bonds was picking up. As you can see today, the economically sensitive commodities, so copper, oil, you know, see how much more sensitive they are. And that's, once again, the long bond with this big, you know, big rally on the long end. It's at the same time you got the copper and oil down the most in the commodity space. You know, so the most economically sensitive indicators are pointing toward a crash landing in the economy.
Yeah, I mean, these inflation, you know, break evens, I think, show, we don't have that chart, but the short term inflation break evens have been breaking higher, right? Because of this, you know, 1 year or 2 year because of the tariffs. But the longer term ones have really started to accelerate lower. And I think this gets to the high prices from tariffs are going to crush the economy, because the consumer globally can't pay for 25, 65% tariffs from China. I mean, what does Walmart do, right? What are big retailers going to do, you know, in order to either pass that along, or they're either going to take it in margin, or they're just going to pass it along. Consumers can't take it. And so I think that's what we're seeing
if they
now.
can't take it, then it crushes margins, right?
Exactly. So I think part of it gets taken in margins, and then the other part of it just gets taken in top line momentum, and consumers start to retrench. I do think the U.S. government's making a big bet on immigration, because by keeping the border closed, I think they're hopeful that people don't get laid off, right? And so we don't go through a very large labor contraction cycle this time with massive layoffs, because companies will say, well, I know this sucks and it sucks for margins right now, but if I believe that in the Trump policies of tax cuts, deregulation, supply side reform, et cetera, and I believe that tariffs are going to be here in an environment that's going to be stable, you know, for the next few years, then they're not going to want to lay off so many workers, because they're not going to be able to get them back, because the labor market will remain tight. The government is making this implicit bet by keeping the border closed. And I think ultimately we'll see if stocks are down and margins are getting hit. Historically, companies shed workers, right? But we haven't seen it yet. We had another good payroll, you know, number this morning. Some of the forward-looking indicators on payrolls and the sentiment surveys have been starting to roll over, but it hasn't shown up yet.
Ben, gold versus, so one of the points we make in the book is that we're coming into a period where there's 24 trillion in the NASDAQ 100. The amount of money that's in hard assets relative to financial assets, we've started to see this rotation from financial assets into hard assets. I mean, how long can this go?
Well, let's just go back to what I was saying before, which is credit expansion and credit, like, deleveraging, is that you say there's assets in it. A lot of that's leverage, Larry. Like that just disappears, right? Like, and so when it disappears, then the valuations, which we think of as money, but it's really just a concept that's called divisia money. So like pseudo money. Like you can't, like, although I have actually wrote a paper about how Apple should just allow people to buy their iPhones with Apple shares, since they just rebuy their stock. Like why just cut out the government and let people just like send their Apple shares in for a new iPhone. But anyway, that's a totally aside topic. Point is that we're in a situation where like the gold is reasserting itself, but it's had a huge run, right, Craig?
Yeah,
I mean, like,
yep.
And just so everyone knows, I mean, you can go, my pinned tweet on my Twitter is 18 months ago, and I was telling people it's like time to go all in gold at like $1,900, $2,000. I mean, we bought some downside convexity in gold 2 days ago, 3 days ago, or something like that, and it's working today. I mean, it's just like all the safe, like Craig, you were talking about like the safe havens they take them eventually.
They hit the I mean, they hit the generals at the end, right?
Or not generals. I mean, like I think the generals are getting taken out already. It's like the safe havens,
like Berkshire has been a safe haven, right? But today it's finally getting its comeuppance, right?
Exactly. Berkshire and gold have been two of the best places to like hide, and those are both getting hit today because essentially we're having a one of those days, like margin calls, risk off, people are scared. I mean, look, and I want to be very sensitive to everyone because I've been a very vocal bear, and so but I understand like this sucks for a lot of people, and I've had. All right, we're back. I've had some friends who run funds who are like, having really rough days. So like, I want to be like very sensitive about this. Like, you just have to realize that Craig, where do you think the S&P goes after this? Because we were at 4,200 in the fall of 23 when I wrote that thing on gold, and then we went to 6,200. But we haven't had much earnings growth outside of the AI thing. And now that the AI thing is kind of like rolling in terms of like the economic expectations of it, I think AI is great. I think AI, I use it. I think Craig uses it. But is there a return on it, and how much cost is there in order to provide that for people is a thing. So where are we going, like in terms of the levels on the S&P? I mean, you know.
Yeah, no, look, I mean, I think in a normal earning, I mean, look, I think, earnings are expected. I don't know whether they're expected in like the 270 zone ish. So if we have a kind of margin hit to earnings, we could see earnings down 15-20%. Let's be, in year on year. That kind of brings us down to the low 220, 230 range. And I don't know what's a norm. What's the right multiple on that in a 3.5% 10-year world? Mid-teens multiple? I don't know. So I don't know, 15 times 220. I mean, that's a lot lower from here, right?
Yeah, I think that like basically I think the COVID low inflation adjusted is about 3,100, 2,900, 3,100, somewhere in there, depending on what you use for your inflation adjustment.
15 times 3,300, 15 times 220 is 3,300, right? I mean, that's that's another.
Yeah, that's my view. Is that like when I say I'm buying a little bit today in covering convex positions is because it feels like it's the freak out capitulation day, right? And it might happen Monday. To be fair, Monday might actually be the real day. Like, but the point is that there's no more everyone knows now. So we'll see how much legs this really has.
Yeah.
But I think 4,700 is the line. Like I always thought we were going to 5,100 and we were there today. And that was the August 4th low, as you said, and the carry crash from the day that the Nikkei was down 10% on, their Monday, but our Sunday. And, and we'll see what we do here. But the next level is definitely 4,700, then 4,200, then 3,700, and then the October low, and so we don't know where this is going to come out because you don't actually know the policy. I think that's what people need to understand is like, we can all make do some like simple arithmetic of earnings times a multiple and like make an argument with decent premises. But like the reality is that we don't know what Trump's policies are going to change or going to do.
Yeah.
Is Jake Powell going to actually like cut, or is he going to say, "Oh, we're staying at 4% for the rest of the time"? Like there's things that we just can't decide because we don't know.
No,
like
that's right. I mean, and I think he mentioned it today. He even said they asked him the question about how long they expect it to be until he really knows. He said it could take into next year, right? I mean, so I think that's the environment that we're in. We're in this kind of uncertain macro environment with a little bit with a wild card who's running the show in Trump. But tariffs are here, so that's not that that's good, but they're here. So now we have some direction, like you said, it's the end of season one. The tax cut plan is on the horizon. Congress is going to try to push that through and I suspect it's going to look larger than people realize. It's probably going to have a lot less spending cuts than people maybe want. And so maybe that'll be stimulative later on in the year. We know we're going to get the deregulation. And so there is a path to, better times for the economy and for, Main Street kind of exiting 25 and into 26 into the midterms. That's how Trump has set it up. And so, but the next, few quarters are likely to continue to be this chop with a downside bias until we grind out and find that low in economic momentum and uncertainty. And I think that will, and then we'll kind of go from there. But we typically like to keep these at, around a half hour. So I know Larry's had some trouble with the technology, but, thanks again, Ben, for stepping in here and helping us on this chaotic day.
I mean, what a crazy week, man. And like you said, end of season one. What an opening Trump 2.0
crazy
it has been. I feel like it's already November. Like this year is.
I'm already exhausted. It's exhausting, but
I'm just excited for the Final Four this weekend, brother.
Oh yeah, no, that's true. But you can email us at info@thebeartrapsreport.com to learn more about our Discord channel, our institutional products, and our weekly one idea, which we put out, for the broad audience. So again, Ben, thank you. I know Ben's at Wall Street Beats and does a bunch of other things. So follow Ben at Capital Misallocation is your Twitter handle, right?
No, it's actually at Ben Bry. It's actually my name. But then and so
you can change the name, right?
Capital Misallocation is my Substack.
Right.
But yeah, no, I've enjoyed. I've been a trader forever, and like the last year and a half, I've gotten into the social media a little bit and doing some of this stuff, and it's quite fun. I get to meet guys like Craig and other gentlemen who are partners with, and it's good. I mean, what a crazy time to be having this ability to communicate with people in the real time from all over the world while the market's happening. Like it's so different than I talked about 08. We didn't have this then. There was no you know what I mean? It's a unique time. I think also one thing I would say is don't like lose your head right now. I mean, like selling here and freaking out, I get it, but like at the same time, like, yeah, I don't know. I think like if you really want to sell, like now is not the time, to be honest.
Yeah, look, I think just and patience, right? There's no rush here, as we talked about. We're going to be in a chop environment, so you're going to get a chance. You're going to get a chance to reposition your portfolio into some of the hard assets and think about the things that are going to win under a Trump regime, which are going to be different than what won over the prior 10 years. So, and that's what we talk a lot about in the chat. So, awesome. Thanks, Ben. And
thanks, buddy.
We'll catch you next time.